Most seniors don't realize this, but one simple banking decision after retirement can quietly change who actually controls your money. And once that happens, reversing it is not always easy. Today, we're going to talk about something very important for retirement safety, the joint bank account mistake many seniors don't realize until problems show up later. This is not about fear, it's about clarity. Because once you understand how it works, you don't just protect your money, you also protect your independence, your options, and your peace of mind in retirement. Welcome to Professor Kingsley. If you are new here, I'm glad to have you with us. This channel is dedicated to helping seniors and retirees in the United States understand important financial topics in a simple and clear way. If you find value in these explanations, make sure to subscribe because I upload new videos every day to help you stay informed, avoid common financial mistakes, and make smarter decisions in retirement. Now let's talk about why joint bank accounts are such a sensitive topic in retirement. When you're working and building wealth, financial decisions often feel flexible. You can recover from mistakes, adjust plans, or rebuild over time. But in retirement, your money usually represents years or even decades of accumulated effort. That changes the way decisions should be made. A joint bank account is often introduced with good intentions. Maybe a spouse wants easier access. Maybe an adult child wants to help manage bills. Or maybe it's just a just-in-case setup for emergencies. On the surface, that sounds responsible. But what most people don't fully think through is how access and control can shift once someone becomes a joint owner on an account. And that's where the real story begins. Because in many banking systems, joint ownership doesn't mean helping access. It can also mean shared control. That means both people may be able to withdraw money, transfer funds, or make decisions about the account without needing approval from the other person. Now pause on that for a second. Not because it's dangerous by default, but because it's powerful. Any financial setup that allows shared control needs full understanding before it's created, not after. And yet, many seniors are never clearly walked through what this really means in simple terms. It's often presented as a convenience feature, not a long-term financial structure change. That difference matters more than most people realize, because once money moves into a shared structure, it's not just about trust anymore. It becomes about access rules, bank policies, and account rights. And those rules are not always obvious during the moment you open the account. That's why this video exists. We're going to break down the most important things seniors should understand before, during, and after having a joint bank account. Not in complicated financial language, but in simple, real-world terms that actually make sense in everyday life. And by the end, you'll be able to look at this type of account in a completely different way, one that helps you decide if it truly fits your situation or if there are safer alternatives for your retirement planning. Now let's start with the first major issue that most people overlook. And it begins with something that feels harmless at first, but can quietly shape everything else later. The first major issue with joint bank accounts in retirement is something most people never think about in the beginning, and that is how quickly shared access can turn into full financial control without any additional steps or approvals. When a joint account is created, both names on the account are typically treated equally by the bank. That means both individuals can often deposit money, withdraw money, and manage transactions independently. There is usually no permission system in between once the account is active. And this is where the misunderstanding begins for many seniors. Most people assume a joint account works like a supervised arrangement, where one person helps and the other still fully controls everything. But in practice, it often works more like equal ownership of the same pool of money. That distinction is small in wording, but very large in real life. Now imagine a simple situation. A senior adds an adult child to the account just to help with bills or emergencies. Everything works fine at first. Payments are easier, things feel more organized, and there is no immediate problem. But over time, life situations can change in ways nobody predicted. Relationships can change. Financial stress can appear. Misunderstandings can happen. And even when everyone has good intentions, access to shared funds does not automatically adjust based on circumstances. This is why financial professionals often emphasize that access and ownership are not just technical banking details, they are long-term structural decisions. Once a joint account is established, separating that structure later is not always as simple as removing a name. In many cases, it may require closing and reopening accounts, or restructuring how funds are held. And during that process, complications can appear if there are ongoing transactions, automatic payments, or shared financial responsibilities tied to that account. Another important point many seniors overlook is that banks operate based on account authorization, not emotional understanding or family intent. In other words, the bank follows what the account structure allows, not what was meant informally between family members. If someone is listed as a joint owner, their authority is defined by that status, not by the original reason they were added. This is why clarity before setup is far more important than correction after setup. Now let's talk about something even more sensitive, and this is where many retirees are caught off guard: withdrawal behavior and financial independence inside a joint account. Once a joint account is active, either person may be able to move money without needing to justify the reason to the other account holder at the time of transaction. This does not mean misuse will happen. It simply means the system is designed around access rights, not internal approval between individuals. And that is the part many people don't fully register when they open the account. Because in retirement, your savings are not just numbers on a screen. They represent stability, healthcare security, daily living, and long-term independence. Any setup that changes how easily those funds can be accessed deserves careful thought. This is also why joint accounts are often discussed differently in financial planning compared to other tools like authorized access or power of attorney arrangements. Those alternatives can sometimes provide assistance without fully combining ownership, depending on the situation and legal structure. The key idea here is not that joint accounts are bad. The key idea is that they are powerful, and any powerful financial tool requires understanding before use. Most retirement financial mistakes do not come from risky decisions made intentionally. They come from simple decisions made quickly, without fully understanding how the structure works in real life. And that is exactly why we are breaking this down step by step. Because once you understand how control, access, and account structure interact, the next question becomes much more important. Is convenience worth changing ownership structure permanently, or are there safer ways to achieve the same goal without combining full financial control? That is what we will continue exploring, because the next part focuses on the situations where joint accounts don't just affect access, they can also impact long-term financial planning, security boundaries, and how retirement money is protected over time. Now let's go deeper into something many seniors only realize when they are already inside the situation: the long-term impact a joint bank account can have on financial independence and retirement stability. One of the most overlooked aspects is how a joint account can quietly blur financial boundaries over time. At the beginning, everything feels very clear. One person adds another to help with convenience, and there is usually a shared understanding about how the money will be used. But banking systems do not rely on informal understanding. They rely on structure, permissions, and legal account ownership. Over time, that structure can shape behavior in ways people do not always anticipate. For example, when two individuals share equal access to the same account, spending decisions can become less individually controlled and more shared by default. Even small transactions can start to feel like group decisions instead of personal financial choices. For retirees, this matters more than it may seem at first glance. Retirement income is often fixed or limited compared to working years. That means budgeting, withdrawal planning, and financial discipline become more important than ever. Any structure that reduces clarity around spending responsibility can slowly affect how money is managed month to month. Another important point is that joint accounts can sometimes create confusion during financial planning or record keeping. When transactions come from a shared account, it is not always immediately clear who initiated what, especially when reviewing statements later. This can make budgeting, tracking expenses, or understanding long-term spending patterns more complicated than expected. And while this may sound like a small issue, clarity in financial records becomes very important in retirement. It helps with tax reporting, estate planning, and understanding how savings are actually being used over time. Without clear separation, it becomes harder to evaluate whether financial decisions are supporting long-term stability or slowly reducing it. There is also a psychological aspect that many people don't discuss openly. When money is shared, spending behavior can subtly change. People may feel less individual responsibility over decisions, or assume that the other person is also tracking everything closely. This can sometimes lead to less careful financial habits over time, even when no one intends it. Again, this is not about blaming joint accounts or assuming negative outcomes. It is about understanding how financial structures influence behavior, especially in retirement when long-term savings need more protection and awareness than ever before. Another key area to consider is what happens when life circumstances change. Relationships evolve, health situations change, and financial needs shift over time. A joint account created for convenience at one stage of life may not always fit future circumstances in the same way. But adjusting or separating joint accounts later is not always simple. Depending on how the account is set up, it may require closing accounts, redistributing funds, or coordinating between institutions. That process can become more complicated if there are ongoing payments, direct deposits, or linked services attached to the account. This is why financial decisions like this are often better approached as long-term structural choices rather than short-term convenience solutions. The key idea is simple. Convenience today should not unintentionally reduce flexibility tomorrow. And that leads to an important question that every senior should think about before making or continuing a joint account arrangement. Is the purpose of this account still being served in the simplest and safest way possible? Or has it become something that could create confusion or complexity later on? In the final part of this video, we will bring everything together and talk about practical ways seniors can think more clearly about banking decisions like this. Not by avoiding banks or financial tools, but by using them with more awareness, better structure, and stronger long-term protection in mind. Now that we've looked at how joint bank accounts affect access, control, and long-term financial behavior, it's important to bring everything together in a simple and practical way that actually helps you make better decisions moving forward. At this point, one thing should already be clear. The problem is not that joint bank accounts are automatically bad or unsafe. The real issue is that most people enter into them for convenience without fully thinking through how they change financial structure over time. And in retirement, structure matters just as much as the money itself. Because once your income becomes more fixed, your savings become more important to protect than ever before. Every decision that affects access, control, or visibility of those savings should be made slowly, carefully, and with full understanding. So let's break down the main takeaway from everything we discussed in this video in a very simple way. A joint bank account is not just a tool for sharing banking access. It is a financial structure that can influence control, responsibility, and long-term flexibility. And that is why it should never be treated as a casual or automatic decision. Before making or maintaining a joint account, seniors should always pause and think about a few key questions. First, is this account being created purely for convenience, or is there a real long-term need for shared financial control? If it is only for small tasks like bill payments or occasional help, there may be other options that do not require full joint ownership. Second, do you fully understand how access works in this account? Not just in theory, but in real-life situations where either person can potentially make transactions independently. Third, are you comfortable with how this arrangement might affect your financial independence in the future if circumstances change? These are not complicated questions, but they are important ones. And most financial issues in retirement do not come from complex mistakes. They come from simple decisions that were never fully questioned at the beginning. A safer approach many retirees consider is exploring alternatives that provide support without merging full ownership. Depending on the bank and situation, this could include authorized access features, limited permissions, or legal arrangements designed specifically for assistance without shared control. The goal is not to avoid help. It is to choose the right kind of help for your situation. Because in retirement, the real priority is maintaining clarity and control over your financial life for as long as possible. Not just for today, but for the years ahead. Now, before we finish, take a moment and think about your own situation. If you already have a joint account, do you clearly remember why it was created and whether it still serves that same purpose today? Or was it something that made sense at the time, but has not been reviewed since? That reflection alone can be powerful, because many financial decisions stay unchanged for years simply because nobody revisits them. If you found this video helpful, let us know in the comments. Your experience might help another senior understand something they have been unsure about. And if you know someone who has a joint account or is thinking about opening one, Sharing this video with them could help them make a more informed decision before it becomes a long-term structure they didn't fully intend. Thanks for watching, and as always, take care of your financial decisions with patience, awareness, and confidence.